On tap for today is a trip to the Buckeye State, home to a bunch of U.S. presidents, the country's only pennant-shaped state flag, and also to my favorite baseball team, the perennially mediocre Cleveland Indians. But more importantly to you all, it's also a state that's seeing some pretty good numbers in the apartment sector, and that's what we're going to talk about today. I'm Jay Parsons. This is Greg Willett. Welcome to Apartment Market Dynamics. And Greg, hit us up with some of those numbers from Ohio.
Well, when we talk about Ohio, we're actually going to put the big six cities there together and looking at what's happening in the apartment sector. When you combine those areas, and the size by stock includes your favorite Cleveland, plus Cincinnati, Columbus, Dayton, Toledo, and Akron. Combined, they have 592,000 units. That would make it combined about the size of Houston or Washington, D.C. or the Bay Area. So looking across the MPF top 100 markets, they represent 4.2% of the existing inventory. And they're really right now outperforming in terms of demand. We've got a graphic for you. Keep in mind that 4.2% share of existing inventory. If you look at the year ending first quarter, these metros absorbed 13,125 units. That's 5.7% of the total absorption across this MPF 100 data set. And then specifically in first quarter, they did really well, absorbing 3,975 units, 9.7% of the total absorption, so really more than double what would be their fair share. And at Jay, as you explain that, what you really often do in the housing market is to look at what's happening with the employment numbers, and they help tell that story. And looking on the employment side of things, Cincinnati is really the best of the bunch now. It's getting annual employment growth at 2.2%, meaningfully above its long-term average. And I would describe the economies as pretty solid as you look across Columbus, Toledo, and Dayton. A little bit of a laggards in Cleveland and in Akron with basically flat employment over the past year. But dig down into those numbers and you see there's some government job cuts that are counterbalancing some expansion in other industries. And so that really suggests in those other industries, you're creating some jobs for some young adults who are likely to be apartment renters.
And with that demand and a lack of new supply, that means some healthy occupancy rates. Take a look at this chart here, and it's going to show you some interesting numbers. In Akron, occupancy is at 97.2%, Cleveland's at 96%, Dayton is just under that, 95.8%, and both Columbus and Toledo are at 95.1% occupancy. Then Cincinnati comes in at 94.9%, and with the U.S. average as of first quarter registering at 94.9%, that means every one of Ohio's big six apartment markets has occupancy in line or better than the national norm. Here's a little trivia for you. That is the first time that's happened in the 2 decades that we've been tracking the Ohio markets. That's a pretty long time.
It is a long time, and we've been writing about these markets for that long. And if you go back into our reports over that time period, the term perpetual laggard is what we tend to always throw in there when we talk about Dayton. So particularly that one stands out at me as being somewhat of a surprise.
And with these good occupancy numbers, are we seeing much rent growth?
We are seeing some rent growth, but when you compare it to what you're seeing on the occupancy side, the rent growth is not above the national average the way it is with occupancy. And another chart for you looking at the rent growth numbers, you see that best in the series is Columbus, 4.6% annual rent growth. That actually does match the U.S. average for the year ending first quarter. Akron is at 4.1%, Dayton 3.6%, Toledo 3.5%, and Cincinnati 3.1%. That leaves Cleveland as the laggard there, 2% annual rent growth in that one.
And our fans in Cleveland, which are probably a lot of my family, they're probably wondering, why is Cleveland so far down the list? What's going on there?
You know, in that one, I think it's really operator attitude more than anything else. It's a place that looks like it could actually handle some more aggressive pricing increases. And operators, you get off a little bit on the cycle every once in a while, but they pick up on that pretty quickly. And so as we go into the heavy leasing season in spring and summer of this year, I would really expect that annual rent growth number in Cleveland to come up quite a bit.
And looking at all these markets, what kind of where do you see some vulnerabilities? Where do we have potential and maybe see some backtracking in occupancy or rents?
Well, we're pretty confident in these markets moving ahead overall, but if there is a little bit of vulnerability, I'm going to say watch Cincinnati. And what we've seen is rent cuts there during the recession really weren't very steep. And as you've had ensuing rent growth, you're pretty far above the historical averages in Cincinnati. And also, it's an area where single-family homes are really popular, and propensity to buy is pretty high there. As you get some very solid employment growth, and again, Cincinnati is doing better on the employment front than any of these other markets, some loss to purchase, I think, will be starting to show up pretty quickly.
So there you go, 6 metros for the price of 1 today. That wraps us up for Apartment Market Dynamics. Until next time, for Greg Willett, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.